Hello everyone, welcome to my lecture on Unit 5 Topic 5 Funds Flow Analysis. Introduction. The term funds will generally mean cash, but from the accountant's point of view as well as finance managers' point of view, funds means working capital or net working capital. In the context of funds flow statement, when we use term funds, it means working capital only. A funds flow analysis is a financial document which you can create and use to analyze and understand the financial position of your business. More importantly, it sets out where funds are coming into the business and how they are being utilized or used. Funds flow analysis also monitors working capital. It begins with the monitoring of working capital. Objectives of funds flow statement. It helps to, once a funds flow statement is prepared, it helps us to identify the different sources and application of funds. It explains the sources of raising funds and how the same has been utilized. And also it answers the following specific questions. How could the firm pay dividends at a higher rate despite declining profits in the year? Is the firm solvent or not? How the company has financed its fixed assets? Why does the company find difficult to pay dividends through it? It has made good profits. Though it has made good profits. So the actual procedure of the funds flow statements begins with here. Preparation of funds flow statements involves 3 stages. The first stage is preparation of statement or schedule of changes in working capital. Second stage is preparing the statement for funds from operations. And third stage is funds flow statement, which represents or which displays the sources and application of funds. So first we are going to learn the first stage of funds flow statement, that is preparing the statement or schedule of changes in the working capital. So these are the following rules for preparation of statement of changes in working capital. That is, 2 years balance sheets will be provided as a data from which we need to ascertain or which we need to prepare the statement relating to the changes in the working capital. So for this working capital preparation of working capital statement, we require current assets and current liabilities. Working capital, we require current assets and current liabilities. So increase in current asset will result in increase in current asset results in increase in the working capital. Decrease in current asset will result in decrease in working capital. Whereas decrease in current liability will result in increase in working capital, and increase in current liability will result in decrease in working capital. Here if we observe the changes of working capital, when there are changes in the current assets, here there is a direct relation of the change in the working capital as well as change in the current asset and change in the working capital, whereas when it is liabilities to the working capital, it is inverse related. relation. So we find a direct relationship between current assets and working capital and inverse relationship between current liabilities and working capital. This is the formula for ascertaining the current working capital. It is current assets minus current liabilities. So these are a list of current assets and current liabilities which we generally come across when the balance sheet figures are given to us or provided to us. So identify the current asset and observe whether there is a change, either increase in it or decrease in it. Similarly, identify the current liability in the balance sheet figures given to us and determine whether there is an increase in that current liability or decrease in the current liabilities. So this is a format for you given is here. Proforma or a statement of changes in the working capital. This is a format having particulars in one column, previous year figures and current year figures, and working capital changes. Working capital changer, whether it is a decrease or whether it is a increase or decrease. So in the particular columns, the first will be calculating the current assets. Next comes the total of the current assets will be done here for the previous year as well as the current year. Similarly, current liabilities will be listed out in the next step, and the total of the current liabilities for the previous year and the current liabilities for the current year is calculated. So here the net working capital will be, if current assets is denoted as the total of current assets is denoted as A and total of current liabilities is denoted as B, your working capital will be A minus B, that is current assets minus current liabilities. So this will be the working capital for you. So the total of increase in the current assets or current liabilities will be seen, as well as decrease in the current assets and current liabilities will be seen here. Okay, this is how the format looks like, in which pattern we are going to prepare the statement of changes in working capital. Now the small problem given for us here is a problem. From the following balance sheet of XYZ Limited, prepare a statement of changes in the working capital. So the given year capital and liabilities are given for the year 2016 and for the year 2017. The share capital is there here. These are current liabilities, share capital, sundry creditors, bills payable, as well as profit and loss account details. And assets, machinery is given, stock, debtors and cash are given. So out of this list of capital and liabilities as well as assets, we need to identify only the current assets and current liabilities, right? Here this is the current liability, this is the current liability. Here it is current asset as well as current asset. Now this is a format where we are going to calculate the changes in working capital. To begin with, current assets under particulars column. This is the previous year figures and the current year figures. So if we see, the cash is already, almost all it is nothing but all the year figures are already given here. So straight away we can analyze from here itself instead of going back to the previous slide. So previous year cash amount is 96,000. Present year or the current year's cash is 1,40,000. It is a significantly, it is observed there is an increase in the cash from the previous year to the current year. By how much it is there is an increase? This is the total amount. So difference is 1,40,000 divided minus 96,000. It will be 44,000 increase in the cash. Overall increase in the cash. Okay. Similarly, debtors, it is 3,62,000 previously and it is 3,40,000 now. So there is a difference from the previous year to present year. So there is a decrease in the value here we can observe. So what is the decrease in the amount? It is the net effect is decrease in the current asset by 22,000. Right? Similarly, stock. Previous year value is 2,40,000. 2,42,000 and present year is 2,72,000. So there is an increase in the stock value or the stock worth of stock but to the extent of 30,000 rupees. Right? Now here once all these things are listed out, we are going to make a total here of the current assets. Right? So it is for the previous year it is 7 lakhs and for the present year it is 7,52,000. Right? Now coming to, let us assume this is as A, total of current assets is, we are denoting it as A. Now listing out the current liabilities similarly, here sundry creditors is 1,60,000 and it is 1 lakh. So there is a decrease in the sundry creditors, that is current liabilities. So the resulting change in the working capital will be increase in the working capital. That is, if the liability is decreased, more amount of funds will be available for your internal usage purpose, that is working capital requirement. So as already we have learned in our previous slide, the current assets increase or decrease is directly related to the increase or decrease in the working capital. Similarly, increase or decrease in the current liability is inversely related to the increase or decrease in the working capital. So when the current liability is decreased here, it is assumed that there is an increase in the working capital. Similarly, in previous year, bills payable or amount due to the creditors were 52,000 and this year, present year, it is come down to 40,000. So earlier this much amount you are supposed to pay by the firm and now it is only 40,000. So there is a decrease in the current liability. It is assumed there will be an increase in the working capital. So we are putting or we are writing the value under this increased in working capital column. Okay. Right? Now these totals are done here. Total of liabilities of the previous year as well as the present year are done here. So let us assume it has a B, this total of current liabilities. Right? So this working capital is nothing but A minus B. That is 7 lakhs minus 2,12,000 is 4,88,000. Similarly, for the present year, 7,52,000 minus 1,40,000, it is amounting to 6,12,000. So when we come to here, if we go by the, how do we balance the statement is, we go by the highest total. Which side is the highest total when compared to the working capital? This side is the, for the present year it is showing the highest total. So we go by the highest total here as well as here. We put the same highest total here and balance it by putting out the balance amount, that is by deducting the working capital from the total. So the residual value is nothing but your balancing figure, what we call it as. That is nothing but the net increase in the working capital. It is calculated, right? So similarly, if we total the increase in the working capital column 1,46,000 and 1,46,000. So which is the total highest total here? This is the highest total. We go by the same highest total here and put the balance amount which is due or which is added, which should be added to the previous the existing amount, so that the total would be 1,46,000. So it is 1,24,000. So this 1,24,000 and this 1,24,000 is, this is nothing but an increase in the net working capital. This is how the statement or schedule of changes in the working capital is prepared. So that was about the first stage of preparation of the funds flow statement. Now here the second stage we come to is funds from operations. The funds from operations, the funds flow statement contains the sources of funds and application of funds. And basically this funds from operation will be initiated with the net profit that is given to us, provided to us, to which these are the listed out items that will be added to the net profit. That also we called it as a non-fund or non-operating items debited to P&L account. So these items will be added back to the net profit, and these are the items which will be deducted from the net profit. So these are nothing but non-fund or non-operating items credited to P&L account. So with this adjustments, we prepare a next statement, what we call as funds from operation or an adjusted P&L account statement. Now there is a problem here given to us. Profit and loss account details are given with all these operating expenses, depreciation, loss and sale of building, this one. From these items you need to identify the items which are non-operating ones, that is which are nowhere related to the business. So here this is operating expenses is purely related to the business. We don't consider it, we ignore it. This is a item we are going to consider for the adjustment. This is another item for adjustment. This is another item for adjustment. Discount allowed is a operational expenses. We ignore. Discount on issue of shares is we consider for adjustment, and written off, that is, and goodwill written off is also will be considered for adjustment. So this is the net profit given to you. Similarly, gross profit and gain by gain or sale of profit is another one which is considered for the adjustment, since it is a non-operating fund credited to the P&L account. So this is a statement here given to us. Calculation of funds from operation. We begin with net profit given in the outer column. Add non-fund operating items which has been debited to P&L account. Just now I have listed out in the data that is given to us. These are the items which we add back to the net profit. So it is coming up to 67,500. So when you add this 52,000 and this all these items which have been debited to P&L account, it is coming to 1,19,500, from which we are supposed to deduct all the non-fund or non-operating items which have been credited to P&L account. In the data given to us, there is one item that is gain on sale of plant and machinery is 20,000. So deduct that 20,000 out of this total. So the resulting value will be 99,500. This is nothing but your funds from operations. The same statement can also be alternatively done in this format. It is a T-shaped account, right? So here you are going to list out all the added items over there to the net profit here, and the closing balance of the net profit, that is the net profit that is given in the data, is we consider here. And by there is no opening balance as such, and the gain in sale of plant is represented on the credit side. And balancing the account, go by the highest total. This side or the left side of the account is showing the highest total. The same total is represented here, and from this deduct the already existing item. The resulting value is nothing but your 99,500 is a balancing figure, which is nothing but funds from operations. So funds from operations, when we do by this method as well as this method, is almost all similar, almost is same. There's an example problem given for you for your further reference or practice purpose. And with this, I'll end up the session here.